Hello everyone. As continuation for our discussion in financial ratios, let us continue discussing other types of financial ratios. So we also have the leverage ratios. So we have the debt ratio, debt to equity ratio, times interest earned ratio. So para saan ang leverage ratios? So it indicates up to what extent the firm has financed its investment by borrowing. So dito natin makikita yung structure ng ating capital. Okay? Yung ating bang capital is composed more from debt, galing ba sa utang, or galing ba siya from the owners itself, or it is a combination of both. Or if it is a combination of both, which one is higher? Is it yung galing sa utang or yung galing from the capital of the owners? So we are going to measure that here in leverage ratios. So firms that use debt financing rather than equity financing increase the risk of the firm. The more debt they incur, the higher their leverage ratio is and the higher the financial risk they face. So typically, nangungutang talaga ang firms or ang businesses. So the more debt they acquire, the more na nag-i-increase naman yung kanilang risk in terms of debt. No? Yung equity financing. Mas mataas yung debt kaysa kay equity financing, it increases the risks in the part of the firm. So the more debt they incur, the higher their leverage ratio, which is equivalent to higher financial risk. So okay ba yung mas malaki ang utang kaysa sa capital na in-infuse ng owners? Or what is the ideal percentage ng ating capital structure? So when obligation is excessive, additional financing may also be obtained from issuance of shares of stocks. So aside from debt financing, kapag kailangan ng funds naman ni business, one way of acquiring funds is to issue stocks or nag-i-issue sila ng shares of stocks. So as an alternative naman, firms may consider stretching the maturity of the debt and making staggered payments. So, karaniwan, yun yung dalawang ways kung paano nakakapag-acquire ng additional funds or nakakapag-source out ng funds yung organization. So, first ratio under leverage ratio is the debt ratio. So, it shows the portion of the total assets financed by the creditors. So, yung capital structure natin, it shows the portion of the total assets financed by the creditors. So, as you can see here, our formula is total assets over total liabilities. So, debt ratio tells us the portion of our total assets, how much or ilang percent ng ating assets ang financed by our creditors. So the provider of funds other than the stockholders prefers to see a low debt ratio because there is a greater chance for creditors to collect their receivables when the firm goes bankrupt. So here, mas mababa yung ating makukuhang ratio, mas maganda or mas okay. Okay? Kasi ibig sabihin, yung composition nila ng assets hindi nanggaling majority from the liabilities or from their creditors. Firms with high debt ratio are more likely to encounter difficulty in securing additional funds. So the more debt they incur or the more na nakikita na mas marami yung utang, mas mahihirapan silang mag-secure ng additional funds because they have existing na utang pa. So kung mangungutang sila sa bangko or to other creditors, at titingnan yung kanilang debt ratio at nakikita na masyadong mataas yung kanilang debt ratio, may possibility na ma-disapprove yung kanilang loan application or pagbaborrow because of the increased risk. So financial institutions that grant loan to firms with a high debt ratio would like to be compensated for the risk they are willing to take by charging a higher interest rate. So, there are creditors na nagtitake pa din naman ng risk na magpautang din sa mga companies na merong higher or high debt ratio. No? But in exchange, they are being compensated for the risk they are willing to take by charging a higher interest rate. So, ang tendency naman dun sa company or dun sa business na gustong mangutang, if they are really desperate enough to borrow, they will accept the higher interest rate na ipapataw no? Magpapautang sa kanila. Okay? So, let's compute. Example. So, for 2012, ang ating total liabilities is 244,000. Then, ang ating total assets ay 375,000. So, ang nakuha natin is 65.07%. So, that means 65.07%, that is the percentage na part ng assets natin na galing sa utang. Okay? So, lumagpas na ng 50%, lumagpas ng kalahati. So, medyo malaki na yan. Okay? Next, for 2013, total liabilities, 250. Total assets, 380,000. So, we have 65.79%. So, nakita nyo, nag-i-increase na naman siya. Next, for 2014, 270,800. Ang ating total liabilities. Then for our total assets, we have 445,000. So we have 60,085%. So if you are going to compare this three, nakikita natin na pababa naman siya. From 2012, no, tumaas ng 2013, and then pagdating ng 2014, bumaba naman yung ating debt ratio. So medyo nag-improve. Okay? Medyo nag-improve yung ating debt ratio, bumaba. That means bumaba ng konti yung ating financial risk. But it doesn't mean na okay na bumaba lang siya. No? Kasi yung 60.85% carries a high financial risk pa din. Kasi mas mataas siya sa 50%. So, ganun kalaki yung percentage ng ating assets na galing po sa utang. Okay? Next, for debt to equity ratio. So, it measures the proportion of the total liabilities to the invested capital. A high debt-to-equity ratio means that the firm financed the assets mostly by debt. Okay. So, mentras na mas mataas na naman, ibig sabihin, yung assets, they are primarily financed from utang. Kapag ka naman low debt to equity ratio, it means that the firm paid for the assets by means of capital, no, and not from utang. Or mas mataas yung from capital kaysa sa utang. Thus, a ratio of more than 1 means that the firm has used more debt than equity to finance its investments. So, a high degree of debt in the capital structure may make it difficult for the company to meet its interest charges and principal payments at maturity. So, mentras ulit na mas mataas, mas hindi maganda kasi mas mataas yung risk. So, here's the formula that we're going to use, total liabilities over total equity. So, ang pinapakita natin dito, no, yung portion nung ating ginagamit na pang-finance sa ating assets. Is it galing sa utang? Mas malaki ba sa utang kaysa sa equity? Or mas malaki ba sa equity kaysa sa utang? So, let's compute. So, for 2012, 244,000 yung ating total liabilities. Then, total equity natin ay 131,000. So, we have 1.86 no, times. Then, for 2013, we have 250,000 and divided by 130,000. So, yung mga data or figures natin ay galing dun sa table na ibibigay ko. Then, ang nakuha natin is 1.92 times, or kahit tanggalin natin yung times, 1.92. Then, for 2014, 270,800 over 174,200. Okay, so 1.55. So, as you can see, pababa naman din yung kanyang trend. No? From 1.86, tumaas ng 1.92 ng 2013, and then bumaba din naman siya ng 1.55. But let's analyze. Kasi ang ibig sabihin pa rin nito is that mas malaki pa din yung galing sa utang kesa sa equity natin. Okay? Kasi ang equity natin is equivalent to 1. So, ibig sabihin, 1.55 yung ating nagagamit. No? Mas malaki pa rin yung nagagamit natin from utang kesa sa equity. Piso lang ang nagagamit natin sa equity, while kay liability, 1.55. No? Yung ginagamit natin pang finance sa ating assets. Same here, kung piso yung ating equity na ginagamit to finance our assets, mas malaki pa din yung ating liability na ginagamit to finance our assets, which is 1.92. Okay? So, medyo risky, no? Kasi mas mataas yung galing sa utang kaysa dun sa galing sa equity natin. Then, for the times interest earned ratio. So, it reflects the number of times the earnings before tax and interest expense cover the interest expense. So, generally, it measures how capable the firm is in paying its interest obligation. So, saan ba nag-a-arise ang interest? Kapag ka merong utang si business or company. So, for bondholders, yung mga pinagkautangan, it acts as a safety gauge. So, ito yung tinitingnan nila. Kung meron capability si firm or si business na makapagbayad ng interest to them. So, it gives a sense of how far a company's earnings can fall before it starts defaulting on its bond payments. So, yung mga bondholders, sila yung nagpautang. So, they are earning through interest. No? So, they are referring to this ratio para makita nila or malaman nila if meron bang capability yung pinautang nila or yung nag-issue ng bonds to them. For stockholders naman, the times interest earned ratio is important because it gives a clear picture of the short-term financial health of a business. So, again, it measures or it shows how capable the firm is in paying its obligations, specifically interest sa kanilang mga pinagkakautangan. So, the formula for TIR or times interest earned ratio is earnings before interest and taxes. So, ibig sabihin, bago ibinawas yung babayaran nilang interest and taxes, magkano yung kanilang earnings, and then divided by the interest expense. So, let's compute. For 2012, ang kanyang earnings, hindi pa nababawas din yung interest and taxes, ay 23,500. And then, ang kanyang interest expense ay 3,000. So, meron tayo na-compute na 7.83 times. So, ibig sabihin nun, 7.83 times na capable si business na magbayad ng kanyang interest expense. Next, for 2013, 34,875 ang kanyang earnings, and then 3,500 naman yung kanyang interest expense. So, 9.96% or times naman, no, na capable siya na magbayad ng kanyang interest expense. Then, for 2014, 36,000 ang kanyang earnings divided by 4. So, 9 times niyang kayang magbayad ng interest expense. So here, mas mataas, mas maganda. Kasi ibig sabihin, the more na mas kaya niya na magbayad ng kanyang interest obligations. Next, we have the profitability ratios. So these are composed of gross profit margin, return on investment, such as return on total assets, and return on equity. So, ano naman ang mini-measure ng profitability ratios? So, these are indicators of good financial health and evaluate how effectively the firm is being managed to earn a satisfactory profit and return on investment. It also measures the management effectiveness in terms of rate of return to sales, assets, and equity. No? So, in short, ito yung returns, no, yung profitability ng business, dito natin makikita. So, investors would be reluctant to invest in an entity that has poor earning potential since the market price of stock and dividend potential is directly affected. So for prospective investors, hindi sila maa-attract to invest to a business na nakikita nila na mayroong poor earning potential. Kaya napakalaking bagay na maganda yung profitability, no, or yung return na makikita ng ating investors. Because nagre-reflect dito yung market price of stock tsaka yung dividend potential na pwede nilang makuha. So creditors would decline to entertain companies with deficient profitability since the amount lent may no longer be paid. So, another disadvantage din na kapag ka hindi nakikitang profitable yung business mo or hindi talaga profitable yung business mo is that mahihirapan kang mangutang. No? So, creditors would decline or disapprove your loan applications or borrowings since they are concerning or they are worrying na baka hindi ka makabayad sa kanila since hindi profitable yung iyong business. So, first ratio under the profitability ratio is the gross profit margin. So, it is a measurement of a company's manufacturing and distribution efficiency during the production process. So, it measures the efficiency of the business or the firm, no, in terms of their manufacturing and production process. No? Yung nami-minimize nila yung kanilang costs na nai-incur in producing the goods or services to be provided, and still, they are acquiring more sales. So, from that, nagiging efficient sila. Firms with higher gross profit margin than its competitors in the industry are more efficient. So here, the more na mas mataas ang ating gross profit margin na mako-compute, much better because it indicates that they are more efficient than the competitors or than the industry. So investors tend to pay more for businesses that have a higher efficiency rating than their competitors, as these businesses should be able to make a decent profit as long as overhead costs are controlled. So the formula that we're going to use is gross profit over the total sales multiplied by 100 to get the percentage. So example, for 2012, our gross profit again is given 44,000 and our total sales is also given 94,000. So if we are going to divide this, we will yield 46.81%. So that means the efficiency rate of the business is 46.81%. So here again, mas mataas na gross profit margin, mas maganda because it means mas tumataas yung efficiency or mas efficient business. Next, for 2013, we have 69,375 for gross profit and 185,000 for total sales. So we yield 37.50%. So from 46.81% from 2012, naging 37.50, so bumaba sa 2013. Then for 2014, we have 60,000 for gross profit and total sales 160,000 times 100%, so 37.50%. So let's compare 2012, 2013, and 2014. We can see that bumaba yung ating gross profit margin from 2012 hanggang 2014. Though, magkaparehas ng gross profit margin ng ating 2013 and 2014, but that means, since medyo malaki yung decline from 2012, medyo bumaba yung ating efficiency. Okay? So, we need to improve the efficiency. Next, for the profit margin, another measurement of management's efficiency. It compares the quality of a company's operations with that of its competitors. So a business that has a higher operating margin than the industry average tends to have lower fixed costs and a better gross margin, both of which give the management more flexibility in determining prices. So this pricing flexibility provides an added measure of safety during tough economic times. So in compare to competitors, profit margin is the measurement of efficiency. So profit margin, our formula is net income after interest and taxes. So after nating bayaran or after nating i-deduct ang ating interest and taxes, yung ating net income, i-divide natin kay net sales. So for 2012, the figures are given 13,325 and then 94,000 yung ating net sales. We have 14.18%. No? So yung ating profit margin or yung ating kita is 14.18%. So here again, mas mataas ang profit margin, mas maganda because it means mas efficient. Next, 2394 divided by 185,000 for our net sales, we have 11.02%. So as you can see here, medyo bumaba na naman ulit yung ating profit margin. So we have 11.02 na dati ay 14.18%. And then for 2014, ayan, so medyo nag-increase naman siya, naging 13% naman siya. So nagpa-fluctuate siya, no? So, kumbaga, that means hindi na may maintain yung efficiency. Hindi na may maintain at the same time, medyo maliit yung increase in terms of efficiency. So, for the return on investment, it measures the income generated for every peso investment made in the firm. The higher the income generated per peso investment, the better. So, the commonly used return on investment ratios are the ROA or the return on total assets and the return on equity or the ROE. So for the return on total assets, it measures the income generated for every peso invested in the assets. So every piso na ginamit or ininvest in the assets, how much is the income? So it is a test of how profitable the firm has been in the use of its assets. So, gaano ba sila ka-profitable, gaano ka-effective and ka-efficient in using their assets to yield income. So, for example, for 2013 and 2014, so again, the figures are given. So, we have the percentage na nakuha natin na 5.40% for 2013 and then 5.0% for 2014. So, medyo bumaba yung ating efficiency in terms of yielding or generating income or profit by using our assets. Then for return on equity, it measures the rate of return on common stock equity. So, yung ating kita o yung ating return in terms of our stocks. So, stockholders invest in a firm with the expectation of a return on their money. So, yung ating return on equity, as much as possible, it must show, no? It should show a higher percentage or higher amount because ito yung magiging pang-attract sa ating mga stockholders. Because stockholders, they want to invest in a firm with the expectation na syempre, merong babalik in return dun sa kanilang ininvest. So, our return on equity formula is net income less the preferred dividend over the average shareholders' equity. So, average shareholders' equity, same way kung paano natin kinuha yung mga average natin. No? So, just simply add the two values and then divide it by 2. Okay? And then for the net income, so we can see this on our income statement and then less preferred dividend. So, itong preferred dividend, ito ay ibabawas natin because preferred dividend are receiving fixed amount of dividends. So, yung mga stockholders, yung mga ibang type ng stockholders or ordinary shareholders, yung return nila nakadepende dito sa ating net income. While yung mga preferred shareholders naman, kaya natin siya ibinabawas, it's because they are receiving fixed amount of dividend. So for 2013, we have 15.63%. And then for the 2014, we have 13.68%. So as you can see here, medyo bumaba yung ating return on equity. Okay, so though hindi siya ganun kalaki, no, pero still we need to improve our return on equity as again because it will be the attracting force for our stockholders.